Hi everybody, it's Jeff here. If you're revising market structures, then a key concept that you will come across and need to understand is that of the concentration ratio. So let's spend a few minutes thinking about that and some examples. So what is the concentration ratio? Well, basically it is the combined market share held by the biggest or the largest firms in an industry. So typically we measure it as a percentage. And it gives us a guide, it gives us a feel for the extent to which there is genuine competition or, conversely, market monopoly control in a particular sector. Now, you can choose any number of firms. We could use the four-firm ratio, CR4, which is simply the combined market share of the four largest firms. Typically, we take the percentage of market sales. So if you have an industry where the top four firms have individual market shares of 30, 25, 15 and 10%, add them together, do the maths. I've done it for you, 80%. And that would suggest an oligopoly because the top four firms have 4/5 of the market. A couple of examples for you. Well, actually three examples. Here's the one that's interesting for me. The leading airlines in the USA. So this is the domestic market share in 2024, actually. So this is the latest data. And you can see here that four airlines dominate the market. So American Airlines, Delta, Southwest and United, and then a whole bunch of others, cumulatively 8%, then Alaska with 6% and JetBlue 5%. So in this situation, you take the top four firms and it's 68%, again suggesting a highly concentrated market share. There will be competition on individual routes, hopefully, for consumers. If you're measuring the five-firm ratio, you take Alaska as the fifth firm because obviously others is the combined share of lots of smaller airlines. Here's the market for mortgage lending in the UK in 2023. Lloyds is the biggest mortgage lender, followed by NatWest, and then Nationwide, which is the UK's biggest building society, and then HSBC, and then Barclays not far behind. So again, taking the top four firms here, concentration ratio is 50.3%. I think that's right. You can check that. So the top four mortgage lenders have more than half the market. This is why we use the data. There is obviously competition between them in terms of setting mortgage interest rates on home loans. But the top four firms have over half the market. And if we were to add in Barclays, our five-firm ratio, which a lot of exam boards use, will be just a tad under 60%. So again, an oligopolistic market, nearly 2/3 of the market. If we include Santander, for example, we take it up to over 66%. Lots of markets change over time, of course. Tesco has been the dominant retail grocer in the UK for many, many years. This chart shows the market share of the leading grocers in Great Britain since 2017. It looks fairly stable within that, Tesco maintaining its position with about a 27-28% market share. But again, if we just strip out some of the data, you can see here that Asda has been losing market share over time from about 16% now down to about 12.5%, whereas the deep discounters, Aldi and Lidl, through rapid organic growth, they have been gaining market share. Aldi growing from 6% to over 10%. And Lidl growing from about 4.4% to just under 8%. So the two deep discounters together have been growing their market share. So what are the advantages of high concentration ratios? Well, typically when we have a highly concentrated market, one advantage is economies of scale. The bigger firms have scaled and they can benefit from cost efficiencies. Their average costs go down in the long run, and this might be passed on to consumers through lower prices. So gains in consumer surplus, potentially. Dominant firms are often very profitable. They have the resources for investing their supernormal profits into R&D, and that can lead to improvements in dynamic efficiency. And I think there's something here, a slightly intangible point, but an important one. Larger firms often have established reputations with strong brand loyalty. This reinforces default choices. People tend to buy from brands they know and trust, especially if they think the brand is reliable and offers good value for money. So that's a kind of, again, people like to buy from brands that they trust. Whereas disadvantages, of course, the risk of market power abuse or monopoly power. Firms may exploit consumers through higher prices, leading to a deadweight loss of economic welfare, particularly if They're pricing way above the marginal cost of supply. So there's a potential loss of allocative efficiency. Of course, you could draw a monopoly diagram to show that. Smaller firms may struggle to compete in these kind of markets, making markets less contestable because the existing firms, the established firms, can use barriers to entry. And a high concentration ratio may limit consumer options, leading to reduced choice. And indeed, dominant established firms with barriers to entry may suffer from inefficiencies, higher costs, due to the lack of real day-to-day intense competition. A little bit of evaluation, couple of evaluation points for you. So we're often asked in an exam to measure the concentration ratio. You either get a high figure or a low figure, or somewhere in between. But those ratios may not capture fully the presence of barriers that can restrict new firms from entering the market. So the pharmaceutical industry often has quite a low concentration ratio at the global level because there are many, many smaller generic drug manufacturers. However, we know that the barriers to entry, such as patents, final regulatory approval, R&D costs, are huge for new entrants. Often they have to merge or pool their resources. Back in 2023, the estimate was the average cost of developing and bringing a new drug to market was over $2.5 billion. And that limits the ability of smaller firms to compete with the giants, such as Pfizer, Johnson & Johnson, Novartis, and others. The other thing is geographic scope. I think this is a key point, actually. So when you get data on the concentration ratio, think carefully about what the market is. Is it local? Is it national? Is it global? So a market may appear highly concentrated at one level, but perhaps more competitive at another. So the UK supermarket sector, we had a look at the chart, didn't we? Tesco, Sainsbury's, Asda and Morrisons have about 2/3 of the market. Asda and Morrisons losing market share to Aldi and Lidl, but still fairly highly concentrated. But a lot depends at a local level. People don't travel 60 miles for their groceries. Competition is often determined by the presence of smaller convenience stores, Londis, Costcutter and others, Nissa, even local independent grocers. So the market may appear less concentrated depending on the geographic scope of the market. Or you might be in an area where there's one big supermarket and that's it. So at a local level, effectively, de facto, you have a local monopoly. So there we go. This is a key concept, the concentration ratio. Really important idea in economics. Worth revising and knowing about when you're writing about your market structures. Thanks for joining in. Take care, stay safe, stay positive, and see you soon.